Hi there, my name is Russ Horn, and I'd like to show you something called the crossover pullback. Now, this happens with just about every moving average crossover that you can get, but I'm going to show you this using medium length moving averages. I'm going to go with a 21 and a 55. These are really good moving averages to show me a bias, and then that's the direction I want to trade. But what happens a lot of the time is when a trader puts moving averages onto the chart, which I'll do right now. So we'll go 21 and then I'll add a 55. So these are exponential moving averages. Make this one a different color, green. What traders tend to do is they will try to trade the crossovers of these moving averages. Now, a really short-term moving averages, you can trade crossovers, a 3-5, 3-8, 2-5, something that's smaller. But when it comes to a moving average like these ones, this is a 21 and a 55. These are more market bias crossovers. What that means is that gives us a direction that the market will likely go. And that's the direction I want to trade. But a lot of traders will see this and they will try to trade the crossovers. Even in marketing material, you'll see that there's a crossover and they expect you to think that the market takes off from there. When the reality is that generally, when you have a crossover of bigger moving averages, the market will want to come back into the moving averages before the market really takes off. So I'm going to mark off some of these crossovers just so we can see what happens after the fact. I'm going to draw a vertical line, but I'll thicken this up, make it solid so that we can see it. So we've got this vertical line. I'm going to draw this in the area of the crossover. All right, now in this instance, if you were to take the trade at the crossover, you'd be trading way up in here. The market would have moved considerably already. Now, granted, the market does move a little bit more, but what happens is the market comes back into the moving averages. And it's at that point that I'd be looking for the long trade, not at the crossover itself. If I look at the previous one, this is where the moving averages crossover, and this candle is way down here. And what's going on is a big market move down. Crossover happens. And then from there, the market pops up and it moves down slightly below that entry. The stop loss would be way up here and we'd end up losing this trade. Market comes right back in to the moving averages. Now at that point, I'd be looking for a short trade. Now, no short trade is triggered. And what happens is the market moves, crosses over in the other direction. So I'd be looking for the pullback into the moving averages at that point. Let's take a look at another one. So we've got another crossover here to the downside. So if I mark that off, this becomes where the crossover happens. Market barely moves in our favor. We get one candle that basically moves and then it's a pullback. And then at that point, it comes back into the moving averages. It tags the 21 EMA. And it's there that I would start looking for the short trades, not at the crossover. Again, let's look at another one. So we get a clear crossover here. This one just before, it doesn't quite cross over yet. This becomes the crossover. We would take the trade. No, we don't want to take the trade. What happens is the market has to move so far in order to make that crossover happen. And it's at that point we're looking for a pullback. Market doesn't go anywhere after this. We get this quick little spike up, but then we get this big move back into the moving averages. So again, it's at that point that I would be looking for the long trade. We've got the bias established. The crossovers are not there to give us signals to take trades. They are there to tell us what direction to be looking at taking trades in. Trying to trade the crossover is going to be a losing endeavor because more often than not, we are going to find that the market retraces. When you have longer period bias type moving averages crossing over, they are admittedly late to the game. They are going to be a little bit later than shorter term moving averages, but that's intentional. We want to somehow filter out the bias. We want to make sure that the market is actually changing direction, and the market has to commit to that in order to show us that. So again, let's take a look at another example. Market crosses to the downside. this one here. Now, this one does move a little bit, but what happens is the market pops right back into the moving averages. And then from there, that again is where I'd be looking to take the short trade. So when we have these moving averages, look for the crossover, look for the pullback into the moving averages, and then be looking for the trading opportunities in the direction of that moving average bias.